It is 3 p.m. live from our new studio in New York City. I'm Julie Hyman. That is Josh Lipton. This is Yahoo Finance Live. And here's what we're watching this afternoon. Wall Street rallies. Stocks in rally mode on this Tuesday afternoon. The Dow popping more than 500 points. The Nasdaq up over 2%. And the surge coming on the heels of the latest CPI report showing that inflation is indeed moderating. Consumer prices were flat in the month of October. Excluding volatile food and energy categories, prices rose 0.2% versus 0.3 estimated.
And investors cheering the report, thinking this could be the end of rate hikes and the Fed could achieve a soft landing. But we spoke to ARK Invest Kathy Wood, who said we're in a rolling recession, pointing to slowing housing and auto sales, as well as soft sales for retailers like Home Depot, which today reported a sales decline since last year.
And despite those sales numbers and a decline in overall foot traffic, shares of Home Depot are trading higher after reporting third quarter results. Revenue and adjusted earnings per share did beat estimates, and digital sales grew by 5%. We've got team coverage of that latest inflation report, but first let's get you up to speed on the market action. Of course, as we mentioned, rallying on the back of that CPI report here. What we're seeing today is buying in stocks, also buying in bonds. That is pushing bond yields down. And really, the narrative here seems to be that the Fed is done. And at some point next year, of course, as we talked about yesterday, there's a lot of debate about when. At some point next year, we're going to likely get a cut to rates. So interest rate sensitive groups like real estate doing well today, but really it's a broad-based rally.
Yeah, so it's just a post-CPI party in that respect, yes. Right? So inflation's cooling, came in lower than a lot of folks were expecting. And so to your point, Julie, yeah, I think a lot of investors thinking, okay, it's officially over. Jay Powell's seen enough. He's stepping to the sidelines, and they're on hold. And when you see these moves here, it is certainly a risk-on day. Look what's moving here. Names like Tesla, it's regional banks, it's small caps. Two-year yields, by the way, plunging about 25 basis points. That's the kind of move we're seeing today. To your point, though, I mean, some economists are saying, is it really time to wave the victory flag? They're saying, listen, if you're banking on cuts, you might not want to hold your breath here. We'll see.
Yeah, we will.
All right, we've got all S&P sectors trading in the green after that latest inflation report. Energy prices, a big factor in CPI being largely unchanged between September and October. Yahoo Finance's very own Inez Ferre has that breakdown. Yes.
Yeah, that's right, Josh. You had gasoline prices that were down 5% month over month, as you were mentioning. Those energy prices really helping to cool inflation. So we're taking a look at our sectors right now. We are seeing energy up 0.8%, but of course a lagger compared to some of the other sectors here. And oil is flat today. You've got WTI at around $78 a barrel. You've got Brent crude at around $82 a barrel. And if we just take a look at the energy stocks, you are seeing green popping here on the screen. But what's really interesting is to take a look at the clean energy stocks, the renewable stocks. Those are surging today. First Solar up 11%, Enphase up more than 15%. As Julie was mentioning, with the bond yields coming down, this is beneficial for these clean energy stocks, for utility stocks as well, because investors are putting money towards these types of stocks instead of higher bond yields. Also, when you have a lower interest rate environment, this is good for these types of stocks because these are companies that require a lot of capital. So if the cost of capital comes down, it's beneficial for these clean energy stocks. I also want to mention some of these are quite shorted because year to date, you are seeing them in the red with Enphase down 65%, Sunrun down 55% year to date. So you may be seeing a bit of a short covering today, guys.
All right, yes, Ferre, thank you for that. And here with more market reaction to the inflation report, we have Yahoo Finance's Alexander Canal and Josh Schaefer. Josh, let's start with you. You are looking at bond yields today.
Yeah, Josh, we're seeing those yields move a lot lower, right? We talked about a little bit off the top here. You take a look at that 10-year off about 18 basis points. And really, guys, one of the biggest reasons I'm most focused on yields is talk to any market strategist in the last month, the last 2 months. One of the reasons they were talking about why stocks were down for 3 months was rising yields, right? We were seeing yields at a 16-year high over the past couple months. So very interesting to see that big of a jump. We haven't seen that big of a jump in a single day since the flight to safety during the regional banking crisis in March. And I did speak to some folks in fixed income today, Kathy Jones over at Charles Schwab, telling me she thinks that this really tells us two key things. It tells us that A, the market feels like the Fed is increasingly done, as we've talked about, and that inflation is on the right track. And overall, it sort of clears up investors to then go into some of those more risky assets. Allie, I know that's something you've been watching overall today, just that flow to maybe a little bit more risk in terms of what yields are showing us.
Yeah, and XLRE, the real estate sector, that is doing very well today. It's the best sector in the S&P. It's having its best month since January and its best day since November 10th of last year. And our very own Jared Bickler said that that day was actually another CPI report. So CPI helping to fuel some of this rally that we're seeing, largely due to the big assumption here that if this is the end of rate hikes, coupled with those falling yields, that will drive mortgage rates lower. And that's been a big reason why we've seen a lot of home buyers on the sideline. This rally, we've seen it extend to other types of home builders, companies like Zillow seeing a rally today. Also, iShare U.S. Home Construction ETF, ticker ITB, climbing nearly 6.5%. And if we see those levels hold to the close, that would be the biggest jump in a year. So really a sea of green right now, especially when it comes to this real estate sector.
Yeah, I mean, what's interesting to me, though, is that we are still seeing an inverted yield curve. Even with everything, even with the big, dip that we are seeing in yields, the 2s-10 spread is still negative here. So I don't know what that says in terms of a recession indicator or what's going to happen on that front. It's just interesting to me, the magnitude of the moves that we are seeing today in reaction to this CPI print, that it was better than expected, but it wasn't like crazy better than expected, right? I mean, inflation is still present.
It feels like it's the narrative building a little bit,
Yes.
though, right? And just getting the reaffirmation of, so we had relatively, people read the Fed's commentary a week and a half ago now, relatively well, right, in terms of the Fed maybe being done. Then you have the jobs report come in relatively in line, not too hot for once. And so people took that relatively well. And so I think it's building on that to have another data point here. I should note some of the folks I spoke to today said, like, to your point, Julie, yes, good news. Let's get more good news, though, before we just price this all the way in, right? We're still very early on in this process in terms of inflation. Chair Powell says that all the time. We need to see a little bit more before we feel too confident.
Right, and immediately following the release of this data, markets were pricing in a nearly 100% chance that there will be no type of rate hike, that they'll hold things steady in December. That's largely been the consensus. We'll see what happens in 2024. But to your point, Josh, Oxford Economics said that there are signs that services inflation will prove sticky, reflecting some of that tight labor market. So with that being said, along with the fact that we're still a ways off from that 2% inflation target, we're not out of the woods yet, to quote the great Taylor Swift.
Well, and to add to that, it felt like
she's the first one who said that.
It felt like the narrative coming into the day was already being about more cuts, right? We were really starting to focus on when are the cuts coming in 24, and I don't think today changes that at all.
No, it solidies it, if anything.
When you talked to those fixed income gurus you're chatting with, did they express any concerns about financial conditions easing in that bond market due to that CPI print?
Overall, they said that the tightening in the financial markets could still come even as yields come down, right? So we talked a lot about, okay, higher yields, tightening in financial markets will come with that. We were talking about yields up toward 5%. But as inflation comes down, if yields come down with it, that real rate doesn't actually move that much. And so you would keep the real rate in the same spot. And so if you're worried about the tightening coming away and then the Fed would have to hike again because yields aren't doing the work for it, we're not really seeing that play out yet, because again, real rates staying in that relative same area.
And I think it's important to note too that consumers are still feeling the price increases that we've seen across the board. So even though we're in this disinflationary environment, prices are still high. Inflation is
They're
still
still higher
elevated.
than it's just the rate of change that is slowing. Thanks, guys. Really appreciate it, Allie and Josh. Well, today's CPI read showing that inflation continues to moderate, helped particularly by falling gas prices. It's good news for the Fed, whose tightening campaign is reaping the desired results. But what is next for the central bank? Here to unpack this further is Yelena Shulyetyeva, economist at BNP Paribas. It's great to see you, Yelena. Thanks for being here. So, you heard the discussion we were having about the Fed. The Fed seems to be consensus here that they're done. Are they done? And if so, what then?
I think I heard a really good word that you guys used. Today's report solidifies our expectations for the Fed to be done. So we have had this projection for quite some time now. We don't see any more rate hikes, and we think the next move will be a cut, which is not coming until June in our view. So, but today's report really confirms our expectations. So even before we got today's numbers, we heard from the Fed, and we heard how their rhetoric has changed over the last several months and weeks. They became so much more cautious. Even as inflation continues to run high, they have become much more cautious, talking about risk approach, risk management, when they conduct monetary policy. So I think today's number just helps to alleviate some of the concerns that the process is not going where it should. So I think in that sense, we just need to see more of the same numbers that confirm the downward trend in inflation. And that would just confirm that the Fed is done. I think also in terms of inflation and gasoline prices, you had a really interesting discussion, and I would like to contribute to that. I think, gasoline prices declined, and that's a rate of change, but gasoline prices remain elevated. And we did see, that pushing inflation expectations up, at least in the Michigan survey recently. So consumers are not happy about inflation still. And today's report showed some deceleration and some declines in discretionary spending categories. So we think that we see some deceleration, some cooling of demand for those discretionary spending categories. That tells me that we're going to see some, and I mean things like recreation and traveling, things like that boosted economic growth during the summer months. I think that is abating, and we're going to see much cooler economic growth going into the year end and into the next year. I think that particular report today is not only telling us about the state of inflation and how price growth is decelerating, it also tells us a little bit about the state of the economy and where demand is cooling. So, and I think that's a very interesting takeaway from today's report.
And Elena, on the state of the economy, the Fed is trying to engineer this, soft landing. So, inflation comes back their 2% target without a downturn. Does that look achievable to you, Elena?
We are in a recession camp, although we expect a mild recession. So we only expect a peak to trough, a downturn of 0.5 percentage points. But still, we think that without some correction in the labor market, it will be very difficult for the Fed to achieve the inflation target of 2%. So we think we need to see some cooling, much more than cooling in the labor market, with the unemployment rate increase, so that price growth really decelerates to where it needs to be. So I think we are not particularly in a severe downturn camp, but we do expect a mild recession. And there are a lot of things pointing to that at this point. You see a pickup in interest rates, not spending interest rate. Consumers have to pay more in terms of interest for credit cards, for auto loans, and that increases delinquency rate on those types of credit. So I think we see that happening, and it will probably intensify over the turn of the year.
And on this point as well, Yelena, earlier I spoke to Kathy Wood, of course, founder and CEO of ARK Investments, and she talked about her view on the economy and what the Fed is going to do. I want to play for you what she said.
Now we're getting more prints again that are saying the Fed probably has overdone it. And you just listen to quarterly company calls, and you'll listen to these management teams, and we have lots of callbacks with managements, and they say, why are you the only one seeing recession? Why can't the Fed see this? This is what we're going through. And I do think the Fed is using lagging indicators for monetary policy, which is unfortunate.
This is something that we've talked about before, Yelena, with regard to the Fed. In Cathie Wood's view, we'll see margins getting hurt at many companies, and the companies that have kept employees around because they were burned during the pandemic when they couldn't find anybody are going to really start to see accelerating cuts of workers. Do you see that kind of a scenario happening?
I think that's what we should expect, and that is exactly what happens when the economy slows down. It happens gradually, and growth in payrolls follows that on a gradual trajectory. Only until a point in economic cycle when growth slows down so significantly that it triggers cuts in jobs. And this is what usually happens. So it's usually a linear relationship between economic growth and employment until it's not. It becomes non-linear when economic growth slows down to such a significant degree that companies need to lay off workers. And I think we're approaching that point. It's very hard to pinpoint, but that's the mechanism, I think. And when it starts happening, one company starts laying off workers, another company will look at it and say, well, these people are laying off people, and we have to follow just to stay afloat.
Yelena, a good reminder for folks who might be celebrating at this CP high print today. Yelena Shulyatyeva, thank you so much. Appreciate it.
My pleasure.
We're just getting started here on Yahoo Finance Live. Coming up, what's on your Thanksgiving plate? We'll break down the holiday foods you should buy and which you should avoid, based on price, that is. Also, our interview with ARK Invest Cathie Wood. We talk all things Fed, Tesla, and crypto. And Airbnb's big AI acquisition. It's first, in fact. We're going to break down the Homestay company's acquisition of Game Planner AI on the other side of the break.
Bullishness on Wall Street as Bank of America raises its price target on Nvidia to a street high of $650. Bank of America analysts calling the company's new AI chips a notable upgrade. Shares of Nvidia set to rise for 10 consecutive sessions now. It's coming as the chip maker gears up to report its quarterly earnings results. That's happening next week. So in the green here again, Julian, this week, of course, announced those updates to its AI chips, right? With that, what it's calling the H200, that was an upgrade to its H100 processor. Where we, of course, had the great Dan Howley on explaining that all to us. More capabilities. We know rivals are circling AMD, Intel, the cloud giants, the hyperscalers. They're designing their own chips. But Wolf Research telling clients this new AI chip further expands NVIDIA's competitive moat. And of course, that's what NVIDIA bulls like to hear.
It is. At the same time, you wonder at what point does NVIDIA get overhyped, right? You know, just when you think it's going to happen and it falls back a little bit, it rallies again with this 10th consecutive day that it's up. It does report its numbers at the end of the month, although I guess we're getting towards the end of the month. It reports its numbers on the 21st,
Yep.
so 1 week from today. And you have to wonder, will that be a sort of sell the news event, right? Is there any way that this company can meet the lofty expectations that are being priced in here? If you look at the forward PE, it's about 45, 46. The trailing PE is over 100.
Yeah.
So does valuation even matter when investors have put so much stock in the dominance of NVIDIA in the AI space? Perhaps not, but it's going to be really interesting a week from today as we're breaking those numbers to see what the stock reaction is going to be.
They had been, remember, it had been under pressure. We had talked about that because of those U.S. export rules impacting sales of chips to China, big market. So I think that'll be another really interesting question. How are they thinking about that when they report on the 21st?
Right. It was under pressure, and then came right back up again. All right, let's talk about Snap as well. It is also moving higher after Amazon reportedly reached a deal that would run shopping ads on Snapchat. That's according to The Information, the tech news site and newsletter. The report did cite a spokesperson from Amazon, but said Snap didn't comment on this. We haven't gotten any comment from the company either. But Jefferies analyst is saying that this partnership, quote, has the ability to solve Snap's two biggest challenges, scaling ad demand and improving ad performance. Snap's actually done pretty well this year.
Yeah, up around, I think, 30, 35%.
Yeah.
I will say, Mark Mahaney, well-known, well-respected analyst over at Evercore, he was less confident about this one. Wasn't as excited. To his clients, he was saying he thought this would be less confident that this would be a meaningful positive for Snap, as he thinks there's overall less commercial intent on Snapchat, as opposed to, he says, like a Meta or a Pinterest. But clearly, investors right now seem excited by that news. That stock is rocking.
I am not a Snapchat user, so I can't speak to commercial intent. You?
Me neither.
No.
No. Well, ask the youngins in the newsroom. They know.
Oh, are you going to have more to say about this next one? Like we heard yesterday, an Airbnb anecdote?
I've done enough, Julie. I've done enough on that. Airbnb shares rising after making its first acquisition as a public company. Airbnb acquired AI company GamePlanner.ai. CEO Brian Chesky saying Game Planner will focus on accelerating select AI projects and integrating their tools into Airbnb's platform. So kind of vague there on what exactly we're doing, but Game Planner AI, now reports say this deal, by the way, if you want to put a price tag on it, reportedly deal's valued at just under $200 million. The startup does have some cred, co-founded by one of the founders of Siri, which was, of course, acquired by Apple. And Airbnb Chesky, Brian Chesky, he has talked about AI in the past, Julie, how the technology could help Airbnb better utilize and personalize the company's data. So perhaps that's what he's thinking here.
Yeah, perhaps so, because all we can do is guess, because we didn't get a lot of details on how exactly this is going to be integrated. It's only a 12-person company. It's in stealth mode, so maybe that's why we are not learning more about this. Is the company's Airbnb's first acquisition going back to 2019. So I think we'll just kind of have to see. I mean, there are some sort of macro headwinds potentially for Airbnb, right? Are we going to see travel slowing down? Although, as we talked about, Bernstein is bullish on Airbnb because they think lodging is going to continue to hold up well. There's also been some regulatory pressure on Airbnb, even in the likes of here in New York City, where we've seen a crackdown on people renting them out. So, can they make up for some of that with more customized solutions? I think I just want more info on
Yeah,
this one.
yeah. I mean, Chesky has
wait.
talked about how maybe he uses AI, the technology, to kind of transform Airbnb from a company, a platform, into more of a travel concierge. So maybe that's what it.
So if you go into an Airbnb and you find, for example, that it's not as clean as you would like it to be, instantly someone can come and
That's the idea.
Clean it up.
It'll be an AI bot. It'll take
you
care
go.
of all our problems. All right, moving on. Consumer discretionary is outperforming today following the latest CPI numbers. Small caps are rallying as well, with the Russell 2000 index climbing over 4% in today's trade, the most in a year. For more on what's causing this surge, we're going to now turn to Eric Green, Penn Capital Management CIO. So, Eric, first of all, let me just get your take on this rally. Obviously, investors are cheering this. The stocks are ripping. What do you think, Eric? Is it time now to really sound the all clear? We can wave the victory flag here on inflation?
Well, the numbers were very encouraging this morning. So I do believe that this is the start of the fourth quarter rally for small cap stocks. It's been long overdue. Large cap stocks have massively outperformed for a long period of time, and valuations have just gotten very compressed relative to large cap companies. Fundamentals are not that bad. The data, the economic data that's come in, the employment report as well as the CPI show that inflation is coming down, and that's one of the ingredients that we need for small cap stocks to work here.
What are some of the other ingredients, Eric? Why right now, besides sort of seasonality, which tends to benefit small caps into year end, why do you think they're poised to continue this rally?
Well, given the valuations discrepancy between large and small, even private markets versus public markets, we think the M&A market is going to pick up. And once the Fed is out of the way, it will give companies more confidence to do deals. And when you have this huge multiple discrepancy, deals from larger companies, even private companies, can be very accretive to buying these small cap companies that are growing faster. And there's a lot of areas in small cap that are completely dislocated from where valuations have been historically. Consumer discretionary being one of those areas.
And what about, Eric, the economy? A lot of people we have on the show, they're expecting a soft landing, but we talk to smart folks who think a recession could be coming too. Or if that's how it plays out in 2024, are small caps priced for that?
Yeah, small caps are actually priced about the average for the amount down from their peak before a recession. So small caps, if anything, are fully priced for a recession, whether it happens or not, where large caps have not priced that in whatsoever. So our economic view is more of a soft landing. However, we're already priced for something that's worse, and valuations reflect a scenario that's much worse than we expect.
What about, Eric, a large cap tech, though? I mean, I look at that, listen, rates move lower, large cap tech moves higher. Why not just stick with that trade?
Because the valuations have gotten way out of hand here on a relative basis. I mean, I do think that the S&P 500 will be okay. It's not going to have as good a returns from the top 7 stocks as it has had over the last year or two, just because other stocks are going to catch up. The market is going to broaden out at some point. And lower rates are helpful to small cap companies, just like they're helpful to large cap companies, particularly ones that need to borrow money. Having these lower rates, if they have floating rate debt, that's very positive for these companies.
Eric, one of the other areas that you sent us some commentary on that I'm intrigued about are the stocks that have gotten whacked about how these obesity drugs are going to take over everything, and nobody's going to eat junk food anymore. Nobody's going to go out to eat. And so some of these stocks have gotten smacked by that. Are you buying some of these restaurant food names, for example?
Yes, we are. And we own some of them already, and we've been buying more of them. It doesn't make any sense. There's some healthcare equipment, medical device companies that have gotten hit really hard on the fear that if people lose weight, they will never have to get knee surgery, back surgery, things like that. This second derivative negative movement in these stocks based on some guess of what's going to happen in the future because of these drugs makes no sense today. When you look at what some of the projections are out there, it's not going to be 50% of the country on these drugs. Not everybody's going to lose a ton of weight, and not everybody's going to stay on it for the rest of their lives. And if they go off of those drugs and they go back to eating the way they were, they're going to gain the weight again. So it sounds great, and I really hope for humanity that these drugs cause people to lose weight permanently and they teach people how to eat correctly. But the reality is it's not going to change the way people do things, at least for the foreseeable investment future.
And Eric, I want to get you out on this one. Traditional energy stocks, you're also a fan. How come?
Sure. I think we're still near the beginning of a multi-year cycle where we have not spent money on producing oil and gas for many reasons, ESG being some of them, other reasons just that companies in the past have spent all their cash flow on drilling more. And now the exploration and production industry, based on a lot of negative comments from Wall Street, has decided that they're going to take some of their free cash flow and give it back to shareholders in the form of dividends and shareholder share repurchases. And they're not going to go out and overspend. Also, we're about a little bit more than 20% less on spending than we were almost 10 years ago. So we're not spending enough to get oil and gas out of the ground. We expect supply to be an issue for some time because of the lack of spending. There are very few new drilling projects, big offshore projects that were announced over the last 5 to 10 years. They should be coming online right now to make up for some of the other projects that are in decline. They're just starting to happen again. So companies that provide services to onshore, offshore drilling, those are the companies we think will really benefit, along with, we think the commodity price is going to remain in this $80 to $100 range for the next few years.
All right, Eric Green, thanks. A lot of actionable ideas for folks today. Appreciate it.
Yeah, thank you very much.
Coming up, Yahoo Finance's week-long special healthcare industry checkup. We're taking a look at navigating a new age in healthcare, sometimes outside the bounds of insurance coverage. That's next.
Stocks are flying after October's inflation data came in surprisingly tame. In fact, the S&P 500 is having its best CPI reaction day in a year, while the dollar is facing its steepest decline over the same time frame. For more on how the markets are reacting, let's get to Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. Stocks love what was happening this morning. We got huge liftoff off of that announcement. The headline number coming in flat month over month. That just sent stock futures flying to the upside, and then we had continuation throughout the day. Now, this here, I got a lot of lines in here. Let me just decode what's going on. This is the S&P 500 in purple, which goes all the way back to those pandemic lows in March of 2020. And then I have the reaction days of the Fed, job days, and CPI days. The three things that are moving the market, if you think about it, those Fed days when all the Fed officials meet and they decide interest rate policy, job days, that's a BLS report that we get once per month, just had one of those, and CPI days like today. What I want to point out is that within the last few weeks, every one of those has ticked higher in the market. And so if we take a look just at what's happening on CPI days, here you can see that big outsized reaction today. It's the biggest since we got almost exactly 1 month ago. It was that date that we were looking at the October 2022 data, and that was pretty tame compared to what the expectations were. That's when we saw this big liftoff here. And in fact, the entire bull market that began October 13th of last year was a reaction. It began off a reaction to the September CPI data. So the CPI data has been very instrumental, and I think the message for the markets is there's really nothing that's slowing it down right now. You think about what's happening into the end of the year, and I want to emphasize this. Hedge funds, at least the macro hedge funds, they are only up an average of 0.1% on the year. They are going to be forced to find a way to match some of their peers, their benchmark peers. The S&P 500, the benchmark, for instance, which is up about what, 17, 18, 20% here. Let's take a look at some of the other movers of the day here. We have the 10-year T-note yield. That is down 19 basis points, the biggest move we've seen in some time. We now have traced out a pretty definitive break from this, what looks like a head and shoulders top here. You take a very simple measured move, half of 1 percentage point, that would take us all the way back down to 4%. I don't necessarily see that happening on a straight line, but I think that's what this pattern is signaling to the markets right here. And then you want to take a look at what's happening in the dollar market. You have lower rates. There's not as much clamoring for higher U.S. interest rates, so the dollars are sold to be able to take advantage of other currencies. We're having the biggest reaction to the downside in the Dixie that we've seen in 1 year. And again, you'd have to go back to that inflation print from last October of 2022. So everything pointing to the potential for a year-end rally. And I'll just go back to some of the charts that I've been showing over the last few weeks. We do, in fact, have tremendous seasonality going into the end of the year. This is what usually happens in November. This is the S&P 500. And then we have the VIX. Usually the VIX declines into year-end. And so just to reiterate one more time, we are on the path to doing that right now. Nothing's for sure, but the obstacles toward a year-end rally just seem to be removed and taken away one by one, guys.
All right, Jared, thank you so much for that. Appreciate it. And turning now to today's installment of Yahoo Finance's week-long special healthcare industry checkup, let's get to Yahoo Finance's Anjali Kamlani.
Thanks, Josh. As part of Yahoo Finance's Healthcare Week, we're taking a look at the modern era of the health industry. Non-traditional players such as Amazon and Walmart have been dipping into the healthcare space, responding to a demand for more consumer-friendly healthcare systems. Meanwhile, there's traditional giants like CVS and United Health Group, and they continue to fuel their expansion in a consolidated industry that is desperate for greater efficiency. This all leaving patients to navigate a new age in healthcare, sometimes outside the bounds of insurance coverage. Here to discuss is Daryl Toll, General Catalyst Head of Health Assurance Ecosystem. Daryl, great to see you. How are you today?
Doing really well. It's nice to see you as well.
Thanks so much for joining us for this special. I know that you are also a former hospital CEO, and this is why we have you on to talk about this today. I want to start off with talking about these moves that you just heard me talk about. All these large companies getting into different parts of the healthcare space. We know that traditional players like CVS, we know as a retail pharmacy giant, but now so much more than that. How is that disrupting what is the traditional healthcare routes that patients navigate?
Well, I think you see a lot of organizations entering the space because of strategic alignment on their part, which creates bounded transformation. I think they are addressing needed change in parts of the system that are associated with their strategies, but then those changes will end when you hit the edge of their boundaries, their strategic objectives. We like the learning, the opportunity that comes out of those, but we're nervous about the fact that transformation across a system, across lifetimes, isn't going to happen based on these bounded strategic efforts, even if the players are unusual. What we're looking for is, how do you create transformation of this many-headed monster called healthcare that has frankly become too complex, lost sight of the consumer, and left a lot of open space that is not yet being addressed for change. And that's something I think that still needs a lot of attention.
Well, and that's where players like Amazon and Walmart come in. We see them sort of, if you will, eating around the edges of the traditional healthcare space, finding the sort of low-hanging fruit and low-cost patients that they then transfer, by referral or other methods to these healthcare systems. I wonder, in this day and age, we know General Catalyst has been looking at, running a healthcare system. I know you're not part of that team, but in the announcement for that, part of what was announced was the idea that this move would then help to create, quote, more profitable, more vibrant, and more innovative systems that serve these patients. I wonder about that profitability part of it. You yourself know what it takes to run a healthcare system. Right now, we're looking at, like I mentioned, looking at these, low-hanging fruit options. Does that sort of create an imbalance of our health ecosystem today that was very focused not too long ago on value-based care?
Value-based care is important, and if you think about value-based care, it's realigning incentives around proactive versus reactive models of care. As importantly is connected care across all of the types and requirements of care, and connected care across a lifetime. And as important as segmented efforts can be in experiments around ways to experience care differently, or maybe a more consumer-friendly approach to care, that longitudinal lifetime of care is most likely to happen in organized systems of care like regional healthcare systems. That's why General Catalyst has put our stake in the ground with healthcare systems to say, yes, it's a difficult time, but the future is bright. It has to be bright. The best options for connected care exist within really well-run, well-built, transformed regional systems of care, and we want to be part of that. So we're looking to build machinery beyond the core of General Catalyst's storied history is venture capital, stage agnostic venture, and a growing healthcare practice there. But we're looking at building partnerships, an ecosystem of change with some of the top health systems in the country. We've started a not-for-profit, and you mentioned, of course, the Health Assurance Transformation Company that Mark Harrison, former CEO of Intermountain, has come in to run. All of these are pieces of a big vision coming together because healthcare is hard, and because healthcare requires a long-term effort that connects to healthcare systems.
So is it basically we're at a point where we have to experiment because we all agree that the current system is broken?
The current system is functioning in some ways, broken in other ways, and in total feels very frustrating to experience. And I think we should preserve the functionality where it exists, and it does exist. There's plenty to celebrate, but it'd be short-sighted to just celebrate in the midst of so much failure. So we're looking at all of those spaces where transformation is needed. Where have other industries transformed? Usually there's an element of connectivity. Always there's an element of consumerism. Often there's a change in incentives. How do those things combine to drive the kind of change that needs to happen in healthcare today?
At the cost, though, of patients out of pocket and in general, a lot more cost to the system, isn't it?
At the end of the day, a connected care model that connects care and coordinates care and provides better information streams and integrates the consumer and decisions being made will drop the cost of care. Realigned incentives that feature value over volume will lower the cost of care. It's an imperative, it must happen. I will say though, value-based care is not synonymous with transformed healthcare. Systems that have essentially value-based care incentives holistically across their network still lack access and consumerism and can be very challenging to navigate. So we have a big project ahead of us.
Definitely. Well, we'll all be watching, and we're definitely watching this healthcare system as it unfolds. General Catalyst Darryl Toll, thank you so much for your time today.
Thank you.
And thank you, Anj, for that insightful healthcare conversation. Of course, part of Yahoo Finance's week-long special healthcare industry checkup that Anj has been helming. Coming up, shares of Snap rising on reports of an ad shopping partnership with Amazon. We'll discuss next.
Shares of Snap rising sharply on a partnership with Amazon. The information is reporting that the deal would allow people to buy Amazon products directly from ads on the Snapchat app. For more on this, we turn to Brent Till, Jefferies senior analyst. Brent, it's great to see you. And you're just the man to talk to about this, Brent. So Amazon, the Snap arrangement, folks are pointing out, Brent, Amazon has similar tie-ups with Meta, with Pinterest. How excited should Amazon investors be about these arrangements?
I think it's another nice to have. I don't know if it's a must have. And I think the challenge that we've had with Snap is that you have a younger demographic that uses it for messaging and doesn't use it to transact. And so one of the key issues that Snap has faced is you talk to most teenagers that are on the platform, they're on it to message, they're not on it to consume and engage and buy things. And so I think that's clearly with Amazon, it's a great opportunity. I think most of the younger demographic doesn't have a lot of money, so Amazon products can be lower cost and it can be a great way to get the awareness built among those younger users. But I think that the real issue has just been conversion, and ultimately is anyone on the system that is a younger audience going to really engage and interact. And in our research, they go to Instagram to interact with brands, and that experience has been seamless. That has not happened at Snap. So real big opportunity for, obviously, for Amazon as another platform. As you mentioned, they're on Pinterest now, they're on other channels, and for Snap, they need anything they can to get things to get this game changed around, because right now they're having a very difficult time.
I mean, what else can they do, Brent? If this is a cohort that just isn't using the platform to transact, like, how do you change that kind of behavior? Or is there another way to monetize them that they're not taking advantage of?
Yeah, I mean, it's a great question. It's one that I ask my kids all the time, because they're on the platform literally 24/7. And I'm like, are you ever influenced by anything? And the answer is really no. And so it's a tough one. And as you've seen, there's been multiple management departures. There's been a revolving door of different line managers. It's been difficult. So never say never. But right now, I don't know what the breakout play is at this point. I don't know if anyone believes there is a mass breakout play at this point. So we're in a situation right now. I think we're in a wait and see. These are all these partnerships are nice. But as they've said in the tech industry, is this a Barney partnership? I love you, you love me. Everyone hugs on stage and disappears, nothing happens. So I don't know if this is a Barney or not.
I've never heard that before. I love that.
Yeah, but I'm stealing it. Brent, I want to switch gears here. As we head into 2024, the boom of interest in AI continues. And I've heard you, Brent, make sort of an interesting analogy when you're talking about AI. I've heard you sort of compare it to 1995, 1996, ahead of the internet. What did you mean by that analogy?
I think the analogy is everyone in the industry is saying that this could be bigger than the internet. And I think everyone's having a hard time really digesting what that means. Sundar Pichai said that at Google. And ultimately, I think, and when we see these big tectonic shifts, right, when we saw mobility, we saw internet, we saw, you wanted to stay long these names in front of these cycles and through the cycle. And ultimately, we're going to hit a bubble. We're not at the bubble now because valuations aren't crazy given the post-pandemic sell-off and the multiple contraction we saw last year. But I think we're in that moment where, AI is going to have a big impact over the next 2 to 3 years. None of these products and software are really having a big impact now. They're going to have a big impact in 24. Remember, all the software companies are buying, the semiconductor companies are buying Nvidia and AMD to build these services. So these services come live next year, and this revenue wave will hit. It hasn't hit today. And we think, again, if you listen to anyone in the industry, they'll say that this is a way bigger impact than Web3, way bigger impact than crypto, way bigger impact than anything we've seen. And again, the best minds have gone back to that mid-90s comment that this is like, would you want to be long the internet, all these internet names from 95 to 99? And the answer was yes. And so I think we're seeing that now with Microsoft up 55% year to date. We're seeing this with Amazon up 73% year to date with the move with AI. And we're just getting started. I mean, none of these companies have monetized in a big way any of these services yet. That will happen next year. So I think, it feels really good. It feels like things are about to build, but many stocks are reflecting how big an opportunity with the move we've had already year to date.
I'm also curious about the backdrop here. We're seeing evidence of it today when rates are falling, tech stocks are just taking off, right? I mean, does that enable more of a move, on top of the AI story over the next year? Does it also enable more froth maybe in these names as well?
Maybe. I think, look, it's been a tale of two cities. Like our hedge fund clients, in general, a lot of them have not had good years. A lot of hedge fund performance has been terrible. So a lot of this is hedge fund chasing. I spoke to our trader just before the segment to get color. We're not seeing a lot of our clients chase this move yet. So to answer, I don't think anyone is chasing this move right now, but it's very true. A lot of the hedge funds have had tough years. A lot of the data suggests that some of these funds are up mid to high single digit versus any index. The semi-hardware or semi-software indexes are all up mid 40 to mid 50%, just owning an index of a basket of names. I mean, that's an incredible move to then be underpinning with a 4, 5, 6% return year to date. So I think we're definitely in chase mode. We're going to be in chase mode from a lot of our funds trying to make up performance for the end of the year. And my sense is, I think I haven't seen the froth yet, and we certainly haven't seen multiples yet go crazy. We've talked a lot about a $15 earning number for Microsoft. A 30 multiple is going to get to $450 in the stock. That's not very frothy. So we haven't seen it yet. Could we see it into next year? Perhaps, but right now I'd say we're kind of the calm before the storm. But this is when you want to be invested and then use the froth as an opportunity to exit.
All right, Brent Till from Jefferies. Thank you so much, Brent, for that time and insight. We love having you on.
Good to see you.
And coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
We're just minutes away from the market close, so let's take a look at some of the sector action today. We're here at the Wi-Fi Interactive. Here are the sectors. All of them are up today, so all of the industry groups are up during the session. Healthcare up the least. Real estate up the most today, Josh. And this has been such an interesting play, I think, not just today, but really over the course of the year. I mean, up 5% today, down 3% year to date.
Yeah, I mean, this is the CPI print. So
yes,
you get the print, you see the Fed stay on hold, so no surprise, you're going to see these rate-sensitive sectors really pick up steam.
Yeah, one of the things that we talked about at the top of the show with Ali Canal is if you do see rates coming down, are you going to start to see some kind of recovery? I mean, this isn't just residential real estate. This would be across real estate. You know, do we see some kind of recovery there? We'll see. Utilities, another interest rate sensitive group there, classically carries a high debt load, also has high dividends. So when rates are higher, it's almost in competition for some of these stocks. Rates come lower, these guys can be a winner here. And then I know you've been paying a lot of attention to the gains that we've been seeing in technology. Obviously, already have had a monster year to date, but up another 2% today.
And you pop the hood. What's interesting, Julie, is what's kind of working is some of those really beaten down names. Like First Solar is having a banner day, but even with that, hasn't done much this year. And then the semis, really on semiconductor, Qorvo, Skyworks also really working in today's trade.
Yeah, we've been talking a lot about Nvidia and the streak that stock
10 consecutive days in the green.
Yeah, so just risk on is what we're seeing today. And there you have the closing bell here being rung at the New York Stock Exchange. Ball Corp ringing that bell, pounding that gavel here on the day as we close out higher. I guess if you're ringing the closing bell on a day like this, you feel pretty darn good. The Nasdaq leading gains today, as we talked about, up 2.4% on the session. The S&P up almost 2%. The Dow gaining nearly 500 points, 490, let's call it, 1.4%. And also just the incredible outperformance of small caps today. I think we got to call that out as well. The Russell 2000 just roaring ahead on the day. We talked with Eric Green earlier, who is bullish on the Russell 2000 into the end of the year. It finished the day up by 5.4%. Seasonally going into a strong period for the small caps, and so that's part of it, but also seen as sort of benefiting as well as these rates are coming down here. I'm just looking at some of the stats here real quickly that Jared Blickery has just sent to us. The Russell having their best day in a year, as did real estate and utilities, which we just looked at. The Nasdaq Composite, its best day since April 27th, and consumer discretionary, helped by the stock we're going to talk about in a moment, having its best day going back to November 30th of last year. So a lot of superlatives as we look at the big rally that we watched today.
And you were referencing there, I think, Home Depot. So let's get right to that name. Shares of Home Depot having a nice big move today. Look at that, up about 5.5% after narrowly beat third quarter earnings estimates while seeing a 3.1% drop in sales. Company CEO Edward Decker said that it is undergoing a, quote, year of moderation as he sees customers spending less on big ticket items. So when you walked kind of through the notes today, Julie, the financial analyst who covered this name, it was kind of a better than feared theme is I think what you kind of pulled out of there. The story here, D.A. Davidson, I think, kind of summed it up. Neutral, their target is 320. The forecast implies, they said, some downside. Business trends clearly remain soft, they said, but probably no worse than most expected. That seemed to really be the kind of the trend among the community.
Yeah, this was not an amazing report that tells us the consumer is doing great, right? As you say, it was a less bad report. So good for Home Depot in the stock sense. What does it mean for consumer spending? What does it mean for the retailers that we are yet to hear from this week? I don't know that that's as strong a positive signal. So really interesting, I think, in that sense, though, that there's that dichotomy, right?
Yeah, and also, I mean, listen, at this point, I'm sounding like a broken record, but again, CPI print. I mean, again, if you think the Fed's on hold and Jay Powell's not going to be so aggressive with that interest rate policy, then you could see why investors kind of piling in.
Right. Is there a feed through for housing? What does that mean for Home Depot? Et cetera, et cetera. Also, other tickers doing well today, EV stocks. Today, inflation read being a key factor. Once again, Tesla, Rivian, Lucid, all trading up following today's CPI numbers. I think that the overall theme that we can take away today is risk on. Right. People were, but not just risk on. I mean, that's what's so interesting about a real estate and a utilities. Those are groups that are typically defensive groups. They were up today, but groups that are typically seen as more risky, more growthy, if you will, like the EV makers, also higher on the session. So
and remember, I thought this was, talk about these EV makers and some of them had a rough sledding. But remember, Musk on that last earnings call specifically called out higher rates, right? He said that's a problem, that's a challenge for my business. So again, if you believe the Fed's done, they're on the sidelines, maybe you think these are some of the names that benefit. Because obviously, listen, when you buy a car, most people do so with some financing, right?
They do indeed. So that could be positive for Tesla. He said rates need to stop going up for them to really get unlocked here. Well, as we've been talking about, these Tesla shares indeed riding higher. The latest inflation data coming in cooler than expected, leading the Fed to potentially take a rate hike off the table. This would come as car companies like Tesla have seen significant impact from higher interest rates. For more on the road ahead for the EV giant, we've got Oppenheimer senior research analyst Colin Rush joining us today. Colin, thanks for being here. We have seen, some recovery here in Tesla, but again, there's a bit of a dichotomy, right? Because Tesla itself, the company, has indicated that things are slowing down a little bit, right? But on the other hand, we're seeing some rate relief. So how should investors be thinking about it?
We're really thinking about this just as some relief just on the stocks, not necessarily on the overall demand profile for EVs. We're really going through a rationalization of the EV supply chain, and I think a market product fit optimization here. And so we're seeing some of the companies go through an evolution of their product offering, and Tesla specifically is going through what we think is a pretty challenging situation to grow at scale and to take market share at scale, because there are real losers now as they continue to take share from here. And we think they really do have a compelling technology platform and cost advantage, but this is really the hard work of industry building and disruption that the company's going through here. And so the stock movement today, I think, is more reflective of positioning in the market. We saw it with the solar names and a number of the higher volatile names or higher beta names that we've got in our coverage universe that specifically have rate exposure on their end markets.
And Colin, earlier today, I had the chance to talk to Kathy Wood of ARK Invest. Tesla is the third largest position in the ARK Innovation ETF. And I talked to Kathy a little bit about, she basically said it's positioning reasons that it's now fallen to that level. She is still very confident in Tesla. And I want to get you to react to what she said. Listen up.
All that Tesla's price cuts have done is offset the interest rate hit. So really, the monthly payments haven't gone anywhere. Tesla will continue to cut prices because it can. Its technology costs are falling, and it's profitable. GM and Ford pulling away tells us Tesla's market share in our 5-year investment time horizon is going to be higher than we thought.
So I guess the question following on that, Colin, is how is Tesla positioned versus its competitors, all of whom are grappling with the rate environment and financing costs, et cetera? Is Tesla in a better competitive position?
So we think they're in a great competitive position from a technology perspective and a cost perspective, where we feel like it's a little bit challenged in her thesis, because she's basically arguing that they won't have to raise prices or they won't have to lower prices to stimulate incremental demand because folks are leaving the market. And we would disagree with her a little bit on that. I think the landscape is changing. I don't see GM and Ford as the primary competition. We're looking at VW and Hyundai as the established OEM leaders in the space, and then companies like BYD in China is the real competition for Tesla over time. And so the worry for us and why we're on the sidelines here is that we think margins are going to be lower for longer than a lot of folks, and that margin expansion story that she's talking about is not going to be necessarily viable, because taking market share means putting folks out of business and taking the market share from them, and they have to get to a price point where they're offering a better value than their competitors on existing vehicles. And what we're seeing in the U.S. is that adoption on EVs is just a little slow because there is a bit of a mismatch on products and market.
And Colin, we had some analysts on the show who were arguing, the UAW getting the deal done with the big three, and some of them came on, Colin, said that was a win for non-union Tesla. Is that how you saw it?
Yeah, absolutely. I mean, certainly there's going to be an effort to unionize Tesla factories and all the battery factories that are serving the vehicle market. But for now, it's certainly an advantage for them, and certainly an advantage versus a lot of the larger internal combustion engine vehicles that are on the market. And so, that labor content ends up being, a meaningful delta in terms of this price environment. So we do see that as a tailwind for Tesla short term. I think there's a much larger challenge around labor and labor pricing in this country, especially as we go into increased automation in these factories. And I think there's going to be, an ongoing conversation, both politically, but also in the business world around what's the right price for labor and what's a living wage for folks.
Colin, switching gears, I got to ask you about the Cybertruck, and notably the headline that somebody uncovered yesterday in the Cybertruck purchase agreement, that if you try and resell your Cybertruck to somebody externally in the first year, that Tesla can try and claw back what you make on it. Josh and I don't read auto purchase agreements, but I assume this is pretty unusual, yes?
Yeah, I haven't seen that before in my life. It's an interesting data point. I think a lot of the folks that are buying, the Cybertruck here in the early edition really are buying it for themselves. That they're not traders in that way. That it's a concern for Tesla is interesting. I think they're a little worried about their backlog eroding. Then that's the only real takeaway from that data point. And so I think what's going to be interesting for the company is getting the volume and getting these vehicles out on the road and seeing how they're really received by the owners once they're out and driving them. And we've seen, the early adopters in Tesla historically be really enthusiastic about the products, but once you get a little bit deeper into the demand curve, there's a little bit more of a mixed response on some of the service and some of the performance. It's the first of kind vehicle with a lot of innovation. They're certainly going to run into a little bit of friction, and it'll be interesting to see how this plays out. But I think they're definitely doing a little protection here with that clause, and it's highly unusual.
Thank you for confirming. We suspected as much, but we didn't know for sure. Certainly, it's highly polarizing before it even hits the road. So we'll see how it turns out. Colin Rush, great to catch up with you as always. Really appreciate it. Coming up, more market coverage on the other side of the break.
Cooler inflation data was just the tailwind stocks needed to head into rally mode here. From big caps to the Russell 2000, the bulls are in charge. In the bond market, the 10-year Treasury yield fell below 4.5% for the first time in a long time, and yields have been heading lower, we know, since early October as geopolitical risks spurred haven buying. Those risks have not disappeared. Jens Nordvig says global rates are in a peaking process, and today's moves are important, and this can extend Jens Exante Data's founder and CEO. So Jens, obviously it's a post-CPI party. You see stocks ripping, yields falling. What do you make of these moves, Jens? Do they make sense to you, or are they overdone? What's your take?
So we've been in a multi-year upward process for yields in the bond market and in the entire yield curve, right? And we've been searching for some kind of catalyst for a turn. And today was really important because services prices start to look more well-behaved, right? We've had over the last 3-4 months a situation where goods prices looked like they were much better behaved, but now we finally have the services prices, and we don't need much more of this before the Fed is going to be substantially more relaxed. That's what they've been waiting for. So from that perspective, very, very important data today.
And then, Jens, what data are you seeing in the market itself that convinces you that maybe that is a turn, a more substantial turn, in particular in the bond market?
Well, it's not every day that we see the entire yield curve rally like 20 basis points from 2-year up to 10-year and beyond. So definitely a very big move. We've seen the dollar stage a very big move today as well. It's not often we have 2% moves in rate crosses. So this is certainly something the market is taking note of. And I think rightly so, right? Because we've had a situation where yields just moved relentlessly higher from July up until a couple of weeks ago. And real interest rates got to 2.5%. That was after a multi-year period where real interest rates in the United States were 0 or even negative, right? So this idea that 2.5% was not enough, I think, is really getting pushed back now. And I think there's a very, very good chance that we've seen the peak there. And the next move from the Fed is going to be a discussion about when is cutting appropriate. They're not going to get there tomorrow. It's going to take some time, right? But I think definitely the hawks are on the back foot here. And the doves, if we just get a little bit more data with this type of flavor, is going to start to put when do we want to cut on the table.
So Jens, if the Fed is done hiking, walk us through the impact on currencies then. You know, which currencies benefit and which don't from that decision?
Well, so today we've seen a pretty broad-based move. The dollar is weak against G10 currencies, it's weak against the dollar, it's weak against the emerging market currencies. So if we are in a situation where the lower interest rates are supporting equities, that actually tends to really be beneficial against, your dollar down against everything else. It gets more tricky if we have a combination of lower interest rates, but also, weak growth signals, risk aversion. Then it is only a subset of currencies that will benefit against the dollar. The Japanese yen would be potentially at the top in that situation, gold as well, right? But so far, equities have obviously taken this very bullish, and it's something that's generating dollar weakness pretty much on a very broad basis, including against emerging market currencies.
So Jens, now as we and the market looks to next year and when the Fed might be cutting rates, of course, as our Miles Ludlam pointed out yesterday, it's going to be really important why the Fed is cutting rates. Is it going to be cutting rates because inflation has come down and stabilized? Or is it going to be cutting rates because we've entered a recession and they feel like they need to cut rates to sort of rescue us? Which camp are you in at this point? Or is there any way of really knowing at this point?
No, I think you're absolutely right. Like if it is just because inflation looks a bit better, then you can essentially trim the interest rates a little bit to make them less tight, right? So maybe go from, 5.5% to 4%. That would be that scenario. If it is a situation where the U.S. economy is entering recession and you actually really need interest rates to be easy again, we can talk about very aggressive cuts, right? We would, like most people think, like a neutral rate is in the region 2.5% to 3% normal, right? So we have a long way to go, and those much lower rates would come into play if we have that growth dimension also turning into something that's a dovish signal. We don't really have that yet. So far, it's the inflation news that is better on its own, but I do think there's potential for the growth also to flip, right? We had extraordinarily strange GDP numbers in Q3 with like a 5% handle pretty much. And that is not something that is reflecting what is actually going on in the US economy. We are in a weakening process, and therefore it would not be a surprise if we see some labor market indicators start to turn weaker in the next few months.
So how do you think we're positioned through year end, right? So if today, like putting aside for a moment the weakening that we could see next year in those economic signals and employment measures, there seems to be a growing feeling that it's sort of smooth sailing in equities from here until year end. What are your various data points telling you?
Well, it's always a bit dangerous when there's a very growing feeling, because then it means that's about to be priced in. But I do think in the short term, right, it is a situation where it's inflation driving it. It is bullish if it's just that. And I think it'll take some time before we see evidence that the economy is also weak on a broad basis. So I think for now, the type of market regime that we have seen playing out today is likely to be the flavor the markets will have in the next, I would say, few months. And then the real reckoning in terms of weaker growth and weakness in the labor market is probably more a story that's going to play out during 2024 than imminently in the next few weeks.
Jens, good to catch up with you. Thanks for joining us, Jens Nordvig. Appreciate it.
Thank you.
One of the assets that perhaps surprisingly was not rising today was Bitcoin, even though it has rallied as of late, today falling by some 3.4%. It is on this day that Cathie Wood announced, ARK Invest announced in cooperation with 21 Shares, it's going to be launching a new suite of digital asset ETFs. They will be actively managed. And I had the chance to talk to her about digital assets, broadly about these products specifically, and of course about her still bullish stance on cryptocurrency.
This is the first global, digital, private, rules-based monetary system in history. It's a very big idea. When we wrote the paper in collaboration with Art Laffer, you know Art Laffer, Supply Side Economics, Laffer Curve, he said, I've been waiting for this since they closed the gold window in 1971. So he's been waiting 50 years for this, right? And he's so excited about everything crypto, but especially Bitcoin, because he believes, and it is true, monetary policy around the world is unhinged. It's not hinged to anything except human decision making. And this is going to put discipline, rigor, back into
these particular products you're talking about.
Well, Bitcoin is, the monetary system is Bitcoin. And so, yes, why now for these? We've been working with 21 Shares since I met Ophelia at an ETF confab in 2018. They had really just started their business. And I said, you know, we want to move towards crypto. You are completely crypto. They were focused on the infrastructure, the regulations, really blazing a trail. They had to invent things in order to make this happen. And we knew that was not our core competency. And so but we did start talking. Our core competency is research on disruptive innovation, and they do research. They do deep technical research on the market. Our research is on the disruptive innovation that it represents. And we've just been coming together for 5 years. It was a natural for us to come together. They are, or 21 Shares is the largest crypto ETP provider in the world, $1.5 billion. They have 35 different funds, most of them in Europe, in and around Europe. They were looking for a US entree, and we were looking for infrastructure, and you know, we're just delighted to be partnering with them, given how much groundwork they had to lay for this to happen.
Speaking of groundwork, on another product that you're working on, of course, the spot Bitcoin ETF, which you are also partnering with them on, and you've got your filing in. There's a lot of filings in. Every day, seemingly, there is a new rumor about approval of one of these things. What are you hearing from the SEC at this point? You know, there's a January deadline I know that people have been looking to. Or how confident are you that you're going to get approval?
Well, something has changed. So we had put in a number of times a filing, and we were just denied. never got any questions, really never got any response. This time, this summer, we got questions back from the SEC. Now, normally when you get questions from the SEC, you're just saying, oh my goodness. We were thrilled to get questions back because it means they're engaged now. Now, we have met a number of the research people at the SEC on the research side, and they are extremely sophisticated. They know what they're talking about, and the level of sophistication of their questions suggested, okay, now they're moving deeply into this. And we answered those questions. We have not heard back. That's a good sign too. They never tell you that you've satisfied them, but if you don't hear from them, that usually means that you have satisfied the answers to the requests. So that was new, and we also know that BlackRock got questions. Mm-hmm. We put our answers in first. I think they have followed, and I'm not sure about anyone else. Mm-hmm. That was different, and it says, okay, there's movement, and we are the first in line, just because we kept refiling. Others gave up, and so, but we just kept refiling. We just kept, and we became first in line. So David against Goliath, right? And that's January 10th is the final deadline. Mm-hmm. They've been able to push it. It's very orchestrated. Push it, but the final, they either approve or deny on January 10th. And
what do you think?
Well, again, I mentioned something has changed.
Right.
That's good. The odds have gone up. There is only one wrinkle, just occurred to us in the last couple of days. They will approve a number at once. It won't be just one. That would be choosing a winner, given the way ETFs work. But we know Grayscale wants to convert to an ETF. I don't know how practical that is, or if the SEC will let them, or if they need a special dispensation. I just don't know the rules. Grayscale has said it will sue the SEC again if it denies the conversion. If they were to do that before January 10th, I don't know if that would throw everything up in the air again. I just
for
don't
the
know.
Others as well.
For everyone.
Right.
Yeah, I just don't know. I don't know.
So there's still a lot of unknowns out there. You mentioned you guys bought into Bitcoin at 250 way back when. So the return from 250 to 35, 36 looks pretty good. Yeah. But it's not 100,000 that I think you and I have talked about at various points, or even loftier numbers. Where are we in that cycle?
I think, so if we look at the reasons that Bitcoin will scale, so our base case is today $600,000 to $650,000, and our bull case, based on the scarcity that is now developing, we're at roughly 19.5 million Bitcoin out there. There will only be 21 million ever, and we do believe that. We think that institutions, if the SEC blesses a Bitcoin ETF, institutions will feel like the coast is clear for them to pursue. And we know a lot of institutions have been researching crypto assets for a while and do agree that it is a new asset class. Bitcoin was the first in a new asset class. We wrote a paper in 2000, I think it was 16, ringing the bell for a new asset class. Mm-hmm. And our director of digital assets said to me, do you realize that happened today? We rang the bell for a new asset class. I said, oh, I didn't make that connection. Anyway, so institutions understand when there is a new asset class, it's there's an opportunity to diversify and increase returns per unit of risk. That's very important. They've also learned that that Bitcoin in particular can be a hedge against both inflation and deflation.
So it was a very interesting conversation, obviously. And one of the things that is sort of the hallmark of Cathie Wood is that she is steadfast, right? Even when her ARC benchmark, ARC Innovation ETF was down more than 60% last year. She was still, talking from the same playbook that she really believed in this disruptive innovation. I've been looking at the performance of her various funds, right? ARC Innovation has recovered about 30-some% this year. One of the best performers among her suite of ETFs is actually she has an autonomous tech and robotic ETF also. So it's just been fascinating to follow her over the past years.
It was a great interview. It's so interesting to hear her talk about Bitcoin because you think about that rally we've seen there, and obviously you always put it in context. We're still way below where the record's 69,000. But when you talk about that rally we've seen, I know, Kathy Wood thinks in part that's what she would define as kind of flight to safety, for example, earlier this year, which is the regional banking crisis. But then also clearly, and we've talked to a lot of crypto fans, it's because of this excitement, again, at least among crypto fans, for these kind of spot Bitcoin ETFs.
It's very interesting because if you talk to the Bitcoin faithful a few years ago, not necessarily Kathy Wood, but many of them, they talked about transacting in Bitcoin, that was going to be the thing that was going to unlock the huge potential. Now, the conversation has really shifted to institutional adoption, right? And so the thinking is when the likes of a BlackRock, if the likes of a BlackRock or an ARC gets one of these spot Bitcoin ETFs approved, that you will have that institutional adoption. And I also chatted today off camera with Ophelia Snyder, who is the co-founder and president of 21 Shares, the partner with ARC on this suite of digital asset products. And she seemed to indicate really this is for a lot of advisors, the army of advisors,
the RIAs,
across the country who have clients who maybe are interested in crypto, don't know how to get invested in crypto, or want some kind of actively managed hedged product that RIA themselves might not have the expertise or comfort level to do. Will we see huge demand for this stuff?
Yeah.
We'll see. Will we see huger demand when the spot Bitcoin ETFs start trading if they get approved by the SEC? We'll see. I think it's difficult to tell at this point, and a lot of the action is obviously dictated by price. So it's sort of circular.
If and when the SEC does green light that product, the spot Bitcoin ETF, it'll also be interesting kind of what happens next. In other words, is that a catalyst?
Exactly.
Or is it more like, listen, this was a lot of good news and excitement got priced in?
It's a good question.
We'll
January 10th is the next deadline for when the SEC has to issue its decision.
Also, we got to get Larry Fink on here, who was a skeptic, but no more. I know he talked to some people, he read some stuff. I would love to find out what happened.
Maybe just enough clients clamored to have the thing that he decided he had to. All right, coming up next, we're going to check in on the pulse of the small business community. That's after the break. U.S. small business confidence continued to slide in October. That's according to the National Federation of Independent Business. As entrepreneurs face challenges like labor and economic uncertainty, another wrinkle now added to the mix. According to Goldman Sachs Small Business Survey, a credit crunch appears to be another main worry for business owners. Here to discuss this and more is Joe Wall, Goldman Sachs Managing Director of Government Affairs, along with Tutu Marsden, owner of Dalia Weddings and Events. Thank you both for being here. And you guys, we should mention, are in D.C. You're talking about some pending financial regulation that you say will further add to some of these credit issues. Joe, it has to do with capital requirements for big banks like Goldman Sachs. What's the message that you're trying to bring here, and what are you hearing back from members of Congress?
Sure. Well, thank you for having us on, Julia. So we, to your point, we have about a few dozen small business owners on Capitol Hill today, meeting with both members of Congress, also senior officials at the Federal Reserve. And this comes on the heels of a comment letter that we are sending to the Federal Reserve this week from over 3,000 small business owners who are asking the Federal Reserve to really fully weigh and evaluate the impact of these new proposed bank capital regulations on small businesses. Reason why is that it is already quite difficult for small businesses to access capital. In fact, only 29% of businesses in our most recent survey say they can afford to take out a loan or a line of credit. And when you dig a layer deeper and look at minority-owned businesses, for instance, Black small businesses, only 26% of Black-owned small businesses who applied for a loan or line of credit in the last year received full funding. So that just speaks to how tough it is right now. And the capital requirements that the Federal Reserve are proposing is only going to make that all the more difficult.
And Tutu, let's bring in you as well here. Talk to us a little bit, Tutu, first of all, just about your business, what you all offer, and also touch on, as Joe's noting, this challenge of accessing capital. Is that a challenge for you, Tutu?
Oh, absolutely. Yes. So I am an owner of Dalia Weddings and Events. We are a wedding venue that also hosts other events. And the challenges that we're facing right now is that when we go get a loan, when there's less capital for us to access, that's going to really put a hinder on our growth and what we need to do in the projects that we're have at hand. And so we want to make sure that we can get access to that. If we don't have access to the money in order to grow our business, then there's going to be, our business that could be dire. There could be business that could close down forever. And then there's businesses that are no longer going to be able to grow, be able to hire the staff that we need to be able to expand on our products and services. And so I'm here with, 50 other businesses here in Washington, D.C., but with 3,000 other businesses that have signed this. It's going to be a problematic for us.
Tutu, I'm curious, we've talked a lot about inflation. We've talked a lot about higher interest rates and the effect that they are having on consumers and on small businesses like yours. Can you talk to us a little bit about the environment right now and the effect that all that has had?
Yes, absolutely. So we've been, with the past 3 or 4 years, we've had to deal with COVID. We've had to deal with inflation, with pricing of with gas and utilities, and then food going up, and then also, we've had to had a lot of head issues with having to pay for a lot more. And so when this comes up, where we have to pay for more for the credit and pay it at higher interest rates, it really dampers what we can actually do. And so when we don't have access to capital, we need to make sure that we can get to that.
And Joe, when we say, talk about these small business owners who have this challenge of accessing capital, I'm just curious, Joe, are there certain small businesses that have more of a challenge than others? Certain, sectors, industry, demographics?
Yeah, it's pretty widespread across the board. I would say, where we did see a gap, which I spoke to a little bit ago, is among minority-owned small businesses. So whether it's Black small businesses or Hispanic small businesses, we do see a gap vis-a-vis the overall population when it comes to not only their views on capital, but also in the raw data in terms of those who have actually applied. I mentioned only 26% of Black small business owners that have sought capital in the last year received the funding they requested, and that is in contrast with 41% of the overall population. But I think that the data right now is quite clear. It is a very difficult capital environment, and that's partly obviously because of where interest rates are, partly because of banks tightening credit over the last several months. In the aftermath of the Silicon Valley Bank and Signature Bank issues, and so the new reality is quite challenging for small businesses. And this proposal from the Federal Reserve, will just continue to kind of put the squeeze on small businesses.
At the same time, Joe, what's the balance of lending in this country from small businesses? When we're talking about the financial institutions that'll be most affected by these new capital requirements, it will be the largest financial institutions. What's the breakdown of how much of small business lending in this country is done by large institutions versus small? I mean, you could argue, would there be more democratization of that lending as a result of these capital requirements?
Yes, based on we just did a survey in October and asked, the business owners if you sought capital, as I mentioned before, in the last year, and we also asked, where did you seek it from? And roughly about just over 40% of small businesses sought capital from a large financial institution. And by the way, this rule wouldn't just implicate Goldman Sachs, Bank of America, JP Morgan. It also implicates the top sort of 27 U.S. banks, anyone over 100 billion in assets. So most of the regional banks will be included in this rule as well, which are significant sources of capital for small businesses.
Joe Wall and Tutu Marsden, thank you both so much for joining us today. We appreciate it.
Thank you.
Thank you for your time.
And coming up, market rally, stocks trading higher after that latest CPI report showed inflation moderating, but not all stocks benefiting from the rally. That's coming up next.
Let's take a look at some of the top trending stories today on Yahoo Finance. That CPI print really goosing stocks today, small caps, big caps, whatever, big tech, whatever you want to call it. But there were some stocks that we are sort of watching that didn't do so well. In my neck of the woods, it's Fisker. Those shares are getting hammered today, nearly 20% here. They cut their guidance here, production guidance. It was to 13,000, 17,000. Used to be 20, used to be 32, used to be 44. The problem is they can't deliver fast enough, so they're sort of having to cut that back so they can keep customers happy and don't take too many orders. But even more concerning was they couldn't file their 10Q because they said that they had, quote, determined there is material weakness in their company's internal control over financial reporting. Not good. Their chief accounting officer left the week before earnings. They hired a new one. They're kind of surmising that maybe the guy who left caused some problems. I'm not sure. We'll hear more about that when they actually file the 10Q. So that stock getting hit today bad. A lot of other EV names doing well today, though. Yeah, Pras, I mean, that's what stuck out to me, right, is obviously when you think about some of the conversations we've had about EVs in the past month or so, talking about, GM coming under pressure there, Ford coming under pressure there, those stocks have been weighed on. But the one thing we saw market-wide today essentially was stocks that have been in trouble over the last month. It was basically an all-around rally today. Everything was being bought, so not an ideal day for Fisker to have this news, because Fisker might have been able to catch a bid if they didn't have sort of this negative news, Ali, and they really weren't the only company either that did see that happen. A couple companies today with negative news out that weren't able to sort of overcome and join the rally because of it.
Yeah, I was really curious about this because, like you were saying, we saw a lot of names just do so well for really no reason at all, other than the fact that we have stock surging on the heels of that cooler than expected inflation print. Some other companies to keep an eye on that didn't do so hot include On Holding, the parent company of On Running. Those shares closing down a little more than 3 percentage points due to earnings. Now, earnings were actually not too bad, but inventory was up 62% year over year compared to sales, which were up 58%. So to quote Brian Sazzi earlier this morning, he is the retail expert and has said that when inventory outpaces sales, that can normally be a red flag there. We also see Celsius down. Now they are going through, they announced a 3-for-1 stock split. Was a stock that was doing very well, but again, cannot catch that rally that we saw throughout the broader market today. So it just goes to show that if you have bad earnings, if you have something that the market doesn't like, that investors don't like, doesn't matter how any other, any other stocks are doing, what the broader market's doing, you're still going to get punished.
Bringing a negative vibe on one of the best days for the stock market in 2023.
I was like, this would be fun if we talked about the stocks that weren't doing so well.
Yeah, I mean, that's just, it's a little bit of a downer.
We have to. No, I mean, I think we need to, set expectations a little bit. It's not all great.
All right, let's bring up the vibe. Let's bring up the vibe. I got a fun story for us, and the stock was up. I want to take a look at shares of Penn Entertainment. Penn launching ESPN Bet today. That was a partnership we had talked about going back to August. Penn dropped Barstool Sportsbook, partnered up with Disney. Shares were up today. I think they closed up about a little over 3%. But really, this is the deal we had talked about, over a $2 billion deal with ESPN for Penn to use ESPN's brand for the first time in sports gambling. It's legal in states that Penn previously had licensing in, so not New York, but states like New Jersey, Pennsylvania. You're now going to see ESPN Bet. But that's really all you're seeing, I think, and that's sort of the big takeaway for me from today is, yes, they can now use the ESPN brand to leverage their sports book, but there's not a lot new that comes with the book, at least as of today.
Right, and I think they're going to need that. And just looking at some numbers here, FanDuel and DraftKings combined 70% of the market. You include MGM and Caesars, that's 90. So they're only at 2% right now, Barstool. So in order to get that, at least get that 10%, they got to leverage that ESPN name. Maybe that comes with the on programming branding and the little bugs they can run with promoting the product. I mean, they're going to need that. They need to get at least double digits here to compete with FanDuel and DraftKings that are sort of just dominating, right?
Yeah, we know how adamant Bob Iger is to make ESPN, it's a big focus for the company. And if you think about taking ESPN direct to consumer, there's a lot of possibilities that could potentially happen with ESPN Bet. Also worth noting that tonight is the Netflix Cup, that live golf tournament that they've been talking about.
No one's betting on it.
no one's betting on that.
No one's watching it.
But you are seeing a lot of these media companies really lean into sports as of late. But I want to transition to a couple other stocks that did well today and actually had some interesting news. There's a new report out that Amazon is going to be partnering with social media companies like Meta's Instagram and Snapchat in order to allow consumers that are on those apps to directly purchase products through the platform. Now, this was interesting to see the stock reaction. We saw Snap shares closing up about 7.5% today. Meta shares closing up roughly 2%, with Amazon closing up about 2.25 percentage points higher there. But I wonder when it comes to the users, right? I mean, Snap usually has a younger user base, if that's going to translate to people actually going and purchasing Amazon products.
I mean, Snapchat, we talk about it all the time. They need new sources of revenue. They need new ways to sort of get more out of the users that are on the platform. I totally get the play. I just think you're following something that people already do on TikTok and already do on Instagram, and I don't know if that means people are now going to do it on Snapchat. Like, you're now the third social media trying to do this. I think that space is already taken a little bit, and people sort of already like what they're seeing on the other spaces. Tie up with Amazon, though. I mean,
but I think it can't hurt, right? I mean, for Amazon to be in front of those younger buyers that you want with Snap, and then looking at a B of A commentary about that, it's talking about how Amazon can sort of, with regards at least with Meta and Instagram, is leveraging that really superior targeting technology that Meta has. And if you're Amazon, you're like, why not? Just we get on there, throw them a couple bucks for a sort of a rev share type thing, and then we get more. Amazon doesn't need. They have a ton of revenue.
For
anyway,
Amazon, it makes sense to partner with anyone in that sense, right?
Yeah,
you're not coming to any social media and feed me into Amazon Prime to buy something.
And Instagram is incredibly targeted with their ads. And I can see, I mean, I'm hosting a little Friendsgiving dinner later this week, and I've been looking up a lot of things on Amazon, and I could see myself being on Instagram, looking through my inspo for recipes and things like that, and maybe they would target me that way.
And I think with Snap, you're like, why do they need Amazon? Well, they need the money. Right, so maybe that's part of it, and then potentially you get better products for your viewers that are on Snap. I don't know. Maybe there's some little bit of a win-win there potentially.
Yeah, well, just a report for now. We did reach out to those companies for comment, did not hear back, so we'll see if that is confirmed. Well, coming up, how the latest inflation figures could impact your Thanksgiving Day meal. That's right after the break.
The latest inflation report out just in time for Thanksgiving. Yahoo Finance's Brooke DePalma joins us now to break down what festive foods you should buy or avoid buying based on prices.
All right. So prices are a little bit better, but a few of them are still hard to Gobble down. You got to get in that mood. I've been practicing that one. So we're going to break it down with entrees, sides, and desserts. So kicking off with the main course, the star of the show, the traditional Thanksgiving turkey will actually be the best bang for your buck here. Retailers use those turkeys, of course, as a driver for foot traffic. And so you can expect deals, especially over this weekend. We are seeing prices lower year over year, but beef roast, if you're looking for another alternative to that turkey, up 9.7%. That was one of the largest jumps when it comes to protein due to that slower than expected cattle supply recovery from the impact of the drought. Ham also slight up about 0.5%. Now, as far as sides go, if you're, not the best cooker and you're looking for some canned packaged foods, canned green beans were up 9% and canned cranberries were up 60%. And that's largely due to the fact that packaging costs shot up earlier this year, and that's reflecting the supply chain troubles that we saw. But sweet potatoes up just 4%. But quick side note here, potatoes and lettuce down if you're looking for some other sides as well. And you can't have Thanksgiving dinner without dessert. So if you're looking to make some apple pie, there is some luck there. Apple prices are down 3.9% compared to a year ago. That's because the Pacific Northwest that got hammered a year ago now saw a much better apple harvest this year. Of course, we continue to follow eggs. Those are seeing a decline down roughly 22% year over year, but flour and sugar continues to remain troubled. Sugar jumping 5% year over year. So lots of different dynamics playing into your Thanksgiving meal this year.
Here's the most important question. Gravy or cranberry sauce with turkey?
Ooh. Both.
Why do
I
I have to
actually agree
choose?
with that. Both.
How you put it
And
out there.
stuffing on the side. We didn't include stuffing, but stuffing is crucial for the Thanksgiving
it's critical.
dinner.
Critical.
Of course.
So gravy on your first pass, cranberry sauce on your second?
I can do it all at once. Is that
Really?
weird?
Aggressive at it.
Not at all
No?
weird. No.
Yeah.
And
No,
then the
yeah,
other
no,
question
weird.
is,
Yeah.
the other question is, and I ask this every year, canned cranberry sauce or homemade?
Right.
I never even had homemade. I didn't even know that was an option.
Oh, Josh, you are missing out.
All right,
No.
I'm bringing you in some cranberry sauce.
It's also cheaper.
It's
this
also
year.
the easiest thing to make.
True.
Easier than canned?
Oh, well,
I mean,
it just
very-
tastes so much better.
It's a lot.
We'll tell him. We'll show him, Julie.
Yeah. Oh, Joshy.
Right.
We got a lot of work for you. All right. Brooke, thanks a lot.
Thank you, Brooke. All right, here's what to watch on Wednesday. The big ticket item tomorrow, that is going to be the latest read on retail sales ahead of the holiday shopping season. Consumer spending has been a key trend in the 2023 economic story, headlined by a more resilient, we know, than expected consumer. Wall Street estimating tomorrow's report is going to show some cracks in the consumer's appetite for spending, predicting a drop of 0.3% for October compared to the month prior, which would mark the first negative print since March. And on the earnings front, we will get reports from Target, TJX, and JD.com, among others. Target is expected to be a highlight of a week of corporate reports. Investors will look for updates on retail theft and how the resumption of student loan payments may be impacting spending. So far this year, that stock is down nearly 35%. And it is a big day in geopolitics as President Joe Biden will hold a rare meeting with Chinese President Xi Jinping in California. The pair are expected to discuss trade, Taiwan, and nuclear weapons.
Well, that does it for us today. Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Have a great night, everybody.